And when I say risky, I mean excessively risky behavior. Banks have to take some risks. They ought to take some risks. But I mean crazy risky behavior. Banks are freer to engage in that sort of depositors. So if depositors aren't monitoring the bank, who's left? Well, the shareholders. If the shareholders aren't paying attention, regulators. If the regulators aren't paying attention, then God help us. Right? We know what happens, actually. We saw it in the savings and loan fiasco in the 1980s. Nobody runs. Regulators fail to close insolvent banks. And a problem of insolvency that could have been solved with $10 billion if it had been done promptly, right, as soon as the banks became insolvent, grew to $150 billion because the regulators said, if we wait, the banks will become healthy again. Yeah, well, they didn't. And I fear that we're currently in a replay of something like that, where regulators are deliberately foregoing to close insolvent banks. Citibank, Bank of America. The best indicator of whether a bank is actually insolvent is not the capital it reports to the regulators. There's plenty of evidence that if 8% is the required capital ratio, a bank can maintain 8% capital on its books even while it's becoming insolvent. The indicator that's becoming insolvent is the market value of the bank's shares, because people who are buying and selling its shares want to know what the bank is actually worth, not what it's reporting to the regulators. And so in the Japanese banking crisis of the 1990s, in case after case, the market value of the bank's capital remained at 8%. Sorry, the regulatory ratio that was reported, the book value of the bank's capital reported to regulators, stayed at 8%. For you, time's going this way. The market value went to 2%. And at that point, the bank had to be closed by regulators because it was already actually insolvent. Well, if you're an ordinary depositor, how could you know whether the bank's engaging in a crazy investment strategy? You don't have to be an expert in reading bank balance sheets. You just have to read the reports of people who are. You just have to read Money Magazine. All you have to do is the same thing people do nowadays when they invest in mutual funds. Read a report about what its strategy is and how well it's doing. Okay. If a bank is, there is a way to make a bank really fragile, to make it really run prone. But of course, banks have an incentive not to do that. There's a kind of popular model of the bank run. One of the economists is at Art's alma mater, WashU. Diamond and Dybvig. Diamond is at Chicago, Dybvig is at WashU. And they have this theory, this model of a very fragile bank, and it's internally consistent. The problem is it doesn't describe any bank in the real world. If a bank was really that fragile, how did banking survive centuries and centuries until deposit insurance came along? It sort of doesn't make evolutionary sense. So how did banks avoid being so fragile? The most important thing they did was to hold enough capital. That's what made them secure against asset losses, pushing them over the brink into negative equity, negative net worth, liabilities greater than their assets. So their capital is a cushion that absorbs the losses to the bank. Before deposit insurance, you can go back and see photographs of this. Banks used to paint in their window, typically in gold leaf, "This bank has $5 million capital." Right? When federal deposit insurance came along, the bank hired somebody with a scraper to scrape that out of the window and replace it with a sticker, FDIC. Right? So FDIC guarantees are a substitute for bank capital in reassuring depositors. And the result is predictable. Capital is costly for the bank to hold. Sticker's practically free. Before deposit insurance, banks typically had 20% capital. Nowadays, well, they're supposed to have 8% capital. We're lucky if they really do. But before capital requirements began being imposed, banks had run their capital down to like 4%. Right? Depositors didn't care anymore. Depositors would put their money in a thinly capitalized bank because they were protected by Uncle Sam. Now, the amount of your capital, whether that's adequate, depends on how risky your assets are. Banks held safer asset portfolios. There were no mortgage-backed securities in bank portfolios. There were no subprime mortgages in bank portfolios. In fact, there were almost no mortgages in ordinary commercial bank portfolios. Mortgages were mostly held by specialized savings banks. Savings banks that did not offer checking accounts, so they weren't subject to the problem of rapid withdrawal of money. Banks that needed to be liquid did not tie up their portfolios in long-term assets. So banks were run more conservatively when they weren't protected against the consequences of behaving non-conservatively. Now, in the model where banks are inherently fragile, they're fragile because people run on the bank just out of fear that other people will run. And in the Diamond-Dybvig model, in fact, that's the only thing that causes bank failures, is too many people trying to withdraw at the same time. And so the solution to that is deposit insurance. And here's the really cool part. Deposit insurance is free. It never costs anything. Because once people are assured that they won't lose money should other people run and empty out the bank before they get there, if everybody's assured that they'll get their money back, nobody ever wants to run. And since a run is the only thing that closes a bank, banks never fail, and therefore the insurance agency never has to make a payout. Isn't that great? Like I said, this doesn't really describe the real world, because real world bank failures are not due to runs, they're due to bad loan decisions, 99 times out of 100. And when a run is the thing that precipitates the closure, the bank was already insolvent, usually, not always. There can be mistaken runs, and that's where it is unfortunate. But because that's not why banks fail, but rather bad loan decisions, deposit insurance is costly. Right? Taxpayers are on the hook for bank failures due to bad banking. Today we've got not just partial FDIC coverage, we've got, at least in large banks, blanket federal guarantees. We've got a risk encouragement effect, what economists call moral hazard. We got moral hazard on steroids. So my view is that we would be better off without an FDIC. Now, I'm not saying we could abolish it tomorrow, not the way banks are today. There would have to be a longer process to sort of get banks back toward sounder practices. But we would be better off without an FDIC. What about the Federal Reserve? Do we need a Federal Reserve system? Well, the Federal Reserve System does some useful things. So does the post office do some useful things. Nonetheless, I would like to see it legal for private firms to deliver first-class mail, and then we'll see if the post office can survive. The Fed does some useful things. It issues currency. It clears checks. It processes electronic transfers. It provides a mechanism for banks to pay each other. All those useful things are things that private institutions used to do before the Fed nationalized them. Private bank clearinghouses, founded as kind of clubs among banks to clear checks and to settle up among each other efficiently. Those were all private institutions. It would be more efficient to reprivatize those services. The other things the bank does, the non-useful things the Fed does, enforcing harmful legal restrictions on banks, conducting monetary policy, those we'd be better off without. So we can abolish the Fed. Most of our history we didn't have a Federal Reserve System. Other countries have done well without central banks. Central banks are fairly a latecomer in the history of banking. So without the Fed, what would replace monetary policy? Well, commercial banks would be issuing all types of money, paper currency as well as checking accounts. The basic money, the Federal Reserve liabilities that sort of underpin the entire system, would have to be replaced with something, and the most natural candidate is a gold or silver standard. A gold or silver standard, as Hume explained, will regulate the quantity of money. It'll do so without the need for Ben Bernanke's wisdom. Now there's a second leading argument for having a central bank, besides trying to stabilize the banking system against runs and panics, and that is macroeconomic policy. Right? Smooth out interest rates, smooth out the business cycle. Chairman Bernanke is trying very hard to do that, but the evidence is pretty clear that stabilization policy doesn't actually stabilize. It hasn't worked in practice. It's not that it could never work. There are conditions under which it can help, but more often than not, it works badly. It actually makes cycles bigger. It doesn't carry its own weight. And the reason is not that the Fed is particularly incompetent. Other central banks haven't succeeded either. The problem is that to stabilize the economy, the Fed would have to know more than it's humanly possible to know. And so in practice, the Fed has made inflation higher, it's distorted interest rates, it's fueled unsustainable booms, it's made recessions deeper than they would otherwise be. And our current crisis, our current recession, the result of Alan Greenspan's loose money policies from roughly 2001 to 2006, is just the latest example of that. So we have a crisis due to poor central banking policy, due to mistaken regulatory policy. That should raise, I think, certainly not lower, the likelihood we attach to the idea that the way forward is toward a freer banking system, greater self-regulation in the monetary system. Thanks very much, and I'll take questions.